Let's start with Evergrande, or at least not Evergrande itself, but Evergrande opportunities and the things that you would avoid. Just your thoughts, sir, on that.
Yeah, as you said, the question of the day being Evergrande. I think the key thing, and this picks up from what Stephen Engel was just noting in his comments just previously, is whether or not this becomes systemic. Obviously, Evergrande is very large. I mean, the numbers have been well quoted in terms of the overall debt that's outstanding and the linkages through other parts of the financial system in terms of exposure to banks and in terms of the wealth management products which have been sold. So there's no doubt that this is a significant, very large risk for China. I think the key point here is that policymakers have certainly shown themselves to be very sensitive to anything that smacks of systemic risk and have both the capacity and the motivation to prevent that. So I'm not making any predictions here about what will happen. There's any sort of number of scenarios which one could imagine, but there's certainly it's important to note that there's both the capacity and the motivation to make sure that this is curtailed and managed and does not become a ripple effect that becomes systemic. And we've seen this in the banking sector before, and in the credit markets. China's been gradually trying to reduce some of the moral hazard in the credit markets by allowing, say, smaller areas to go bankrupt, but very much ring fencing anything that's larger and potentially more systemic. So I would imagine that there's going to be motivation to do so in the current situation. Just following on from that, I think that the price effect of this does raise some potential for some for looking for areas that have been perhaps oversold and which are more fundamentally secure. So certainly in parts of the property market, there are companies which are much more fundamentally sound, which may have been overall dragged down by the systemic or broad-based selling which is taking place, and that could be an area for investors to look at once things start to settle down.
Okay, I was going to ask you about that too, because you're still forecasting when it comes to China, the regulatory risk. That's still something that is very front in mind. Where are we in this cycle, and what do you think is in the price right now?
So those are two important questions. I mean, one is we still are clearly working through the whole sort of rolling wave of regulatory tightening which is taking place. In fact, we just introduced yesterday a new proprietary tool that we've developed, which is a China regulation proxy. It's based upon a variety of market-based mechanisms, and through a variety of statistical techniques, we're extracting what we think the market is pricing in terms of the regulatory risk around four key areas, which would include antitrust and financial markets and broader social area, as well as data protection. So it's sort of an objective measure of how much the market's pricing. And not surprisingly, the indicator is at quite high levels, as one might expect. And that suggests that the market still is very much concerned about regulatory tightening, and indeed has priced a fair amount of that in. It doesn't seem as though the current wave of regulatory tightening has fully passed. The intensity still seems to be fairly significant. But that being said, the market has fallen significantly. We've had over $1 trillion of market cap wiped off the particular tech sector. And the overall broad market valuation has fallen to about 13.5 times forward earnings. That's after the earnings have had a pretty significant haircut to them, particularly the more socially focused tech companies. So what we're finding is that we think on a sort of a middle ground scenario, we think the market is actually pretty fairly priced right now. So we think that there might be some potential for valuation recovery in the event we get more of a stabilization in terms of the regulatory environment. And that plus some underlying earnings growth on a one-year view could give us some moderate upside to the broad China index. But we do think that it's going to be still a fairly bumpy ride. It's going to be certainly some volatility, which can be hard for investors to anticipate, because in the political domain, it's hard to sort of predict exactly what will happen and when. So our bottom line here is that we think one needs to still take a fairly measured, somewhat cautious approach to China offshore equities. We prefer the onshore A-share market for a variety of reasons we can drill into later if you wish. And the key point we'd emphasize is we want to be generally more invested in areas that have the tailwind of policy support rather than the headwind of policy regulatory tightening.
In fact, let's do that now, Tim. Why the A-share market in particular, given this fairly comprehensive model that you guys have just run through there with your scenarios?
Sure, for a couple of reasons. One is compositional. So if you look at the sectoral distribution within the A-share market, compare that to the offshore MSCI China market and/or the more specifically tech-focused ADR market in the United States. The onshore Asia market has less exposure to the so-called socially oriented tech part of the spectrum, which suggests less immediate exposure to the regulatory headwinds, which are blowing most severely in that part of the market. So that's number one. Number two, we've noted empirically that the correlation of the A-share performance with the customary policy metrics of monetary and fiscal is much higher than the offshore market. And given our reading tactically of where China's economy is right now, which has obviously been slow, and we've seen the recent data prints which have been soft, we think there may be some moderate, not significant, but moderate easing, perhaps both in monetary and fiscal. And so we think that'll be a moderate tailwind for the A-share market. And then thirdly, there's a very strong, we think, both financialization theme, both in terms of domestic liquidity as well as offshore flows into the China equity market as its weighting in the global indices continues to increase. So in relative space, we think the arguments for A-share is actually pretty compelling.